Hey, welcome everyone. It's Rob. Welcome back to Technical Analysis with Robert Roy. I hope you're having a fantastic day. I hope it's been an interesting trading day for you. Interesting is probably the word I would definitely use, especially with a bit of the move that we took today. So overall, tapping into the, yesterday into our 7,000 level, which was great. We've got a technical level up here that we're looking at with this blue zone. And from last week's show, the first show we did that we aired, we went in all the basis of what I look for in Fibonacci. Today, we're actually going to continue on that series, but we've got a 1,000-point level here, 7,000, and then this negative 272, which is 7,007.24. That is part of the overall Fibonacci pattern. It's an extension at that negative 272. We draw a blue zone inside of there because it's so close. It's not two individual points that we look at, but it's anywhere inside of there. And if I can grab this box, it's pretty tiny. Okay. You can see we stretched up, gapped on the open into that blue zone, pull back. And then today we had even a bigger pullback. If we put some moving averages on there and look at the overall market, right now we're sitting in what would be a bullish neutral bias. And we'll talk bias on another episode, but we've got basically three moving averages. The 8, the 21, and the 55. They're in the right order. Pink is on top. That's 8. Green is in the middle. That's 21. 55 is on the bottom. It's brown. They're all exponential moving averages. You can see 5 EMA, 55 EMA. The 5 is for one particular trade setup. I don't really use it in analysis. If we stay above all the moving averages, we're bullish in our bias. We're down below the 8. We're at a bullish neutral. We're getting close to bullish or in the bullish area, but we're not quite there yet. Maybe not setting up right at this point yet for a trade. And even if it does bounce, we've got this blue zone up here, which came off a previous swing high. We've got a bunch of little swing highs in there, which ultimately were all-time highs, some of them. And then, of course, we tagged the all-time high yesterday with that slight move up there as well. So today we're down 43 points. We were down much greater than that. Big pull down. Right now, my phone lights up from people that are in my mastermind. My masterminds, I belong to 2 of them that I belong in. Plus, there are 3 masterminds that we offer here at Wealth Builders. And my phone lights up from students, friends, family every time the market makes moves like this today. Cell phone goes off, text messaging goes off, my Voxer goes off, emails. It's nonstop. And usually it's panic setting in. But if you look at what's happened, we had a low here. We had a higher low, a higher low, a higher low, and then we finally broke. Well, that caused a lot of panic. Oh my God, we broke. The world's coming to an end. No, markets need this stair-step type pattern to work, right? So this up and down is very important, right? That happening in there is normal reaction in business. You're going to get it 2 steps forward is ideal and 1 step back, right? So we get a nice move up. There's our 2 steps and there's our 1 step back. There's our 2 steps forward and 1 step back. So now it doesn't always work out that perfect or pretty. As you can see, it wasn't that way. But this pullback down into this area here, that's where we've violated the previous swing low and even the one before that. That's where we start to take concern from a technical standpoint. There's some Fibonacci in there and some advanced fibs, which, again, I'll teach you at one point. But there's an ABC pattern inside of here, which gives us this line. This gives us another blue zone. It's very thin. I can't really draw a blue line in there, so I just know it's there. I see 2 lines on top of each other. So I know we've got a blue zone in there. But we gap down here, and this was on Japan, I think, on some fear of economy with dollar. Then this was the tariffs and the war with Greenland and Europe and all of that stuff that came out of the U.S. all the same day. We closed down, great gap up, and then we ran up, closed back up here. We had broken the previous swing low, didn't close above it, but we did break it. And what basically I look at that is this. From a technical analysis standpoint, think that the market, the market maker, the market, whatever you want to call it, think of a chipping hammer, right? A little to chip away at ice, right? The market chipped away at this resistance level up here and basically said, hey, everybody, if you want, it's open. You can go through. And the next day, we gapped right up through there and put us back into a bullish bias. We were bearish here. 2 days prior, we were bearish. We closed bearish neutral, and then we closed bullish on this day. So within 3 days, The gap down day, one more day, and then the next day on the open, we'd gap back up into a bullish bias, and we ran from there into another all-time high. So again, we look at the pattern. Let's grab a red pen. We've got this pattern in here. So you can see some differentiating in there, right? This was a very large move inside of here. The pullback was the steepest one we saw, or the longest one we saw. This line in here shortened up a bit, as did the pullback. This line stayed about the same. The pullback stayed about the same, maybe a little bit less. The move up was the first time we did not get above the previous swing high. In other words, putting in another all-time high. So at that point, what are we dealing with? What are we contending with? Well, there's signs of weakness in there. And if you look at the market, not as what's happening on the right side of the chart, what happened today, but if you'll analyze the market from the perspective of what's been going on overall in the market, and how do I compare today's bar to the rest of the market? If we were sitting in a closing position right now, which of course we're not, we're at 12:30 right now, but if we were sitting in a closing position on the market right now, I'd look at this tonight after market close and say, we are in a bullish neutral bias. What would that represent for me? Well, I can't do anything as far as bullish trades yet until we get back into the bullish bias, which means we are above our 8 moving average. Now, for some, that would mean it's a close above there, and there's nothing wrong with that. For others, we'll look at it and say, I just need to get above there tomorrow, and I'm in. There's not a right or wrong. It just comes down to what your system calls for. What is it that your trading style, your analysis tells you is the right way for you to do it, right? To take that trade. I'd be looking for the move up, but right now I am very hesitant because I want you to think of this. Here, let me do it this way. Oh, good. We got a lot of lines in there. I want you to think of this as you just had a storm in your neighborhood, and this is you right now. You're sitting right there, and you're thinking of taking your car out. And right here, you've got a down wire. Here, you've got some construction debris has blown over from a house that was being worked on. This line right here, there's a bunch of garbage cans in the street, maybe some recycle bins. And then up here, there's more debris. A tree came down, whatever it is. There's a lot of obstacles on what would be an obstacle course here. There's a lot in our way that could slow us down. Now, I'm not saying that this line is very important right now. It's not. I'm not saying this is a very important line right now. It's not, right? This blue zone is not as important right now. This one up here is extremely important up in here, okay? But every one of these levels is a place we can hesitate. And what happens as an options trader is you could buy an option in the morning for, say, $5. The stock runs in your direction. The option goes $5, $6, $7, $8. And all the stock does is hesitate, maybe dip over a little bit. And that $8 option, you bought at $5, it's now sitting at $8. That $8 option now might be worth $6.50 or $7. And the stock has hardly moved because of a volatility flip inside of the options pricing. Bid-ask spreads tend to open up. Prices tend to drip down. Time value deteriorates. Vega, implied volatility, all of those things shift, especially after you get past that first hour of the morning. You know, I'm on East Coast time, so I'll always talk in East Coast, but that 9:30 to 10:30, when you get past that first hour, hour and a half, pricing has a drastic change in how time value deteriorates, particularly. You know, here we're doing the show on a Thursday, so our options either expire tomorrow, right? Or then I'm going to be looking to trade, or they're going to be options on SPY, QQQ that expire today. So I only have a couple of hours left in those options, you know, less than 4 hours basically at this point till those options expire. So we don't have a lot of time left in there, but as you start pushing into the afternoon, that time value is going to deteriorate drastically. All of the volume happens not all, but the largest percentage of volume happens in the morning. So I would much rather have the activity that I'm putting in take place in the morning, right? If you guys have questions, comments, you can drop them in the comment section. I've got it active right here. So it's easy enough for me to see what's going on there. Okay. All right. So overall, I'm not upset with where the market is. That was the whole tirade, that whole rant was to say, I'm not bothered by it. What am I looking at? Well, very simply, I've got a fib line down here. And that fib line, that is my next concern level at 69.03. That's the next place I've got any issues at all. Nothing else bothers me, worries me from there. If we break that, I'm not as worried about this 68.85, but I am worried about the 68.13, 68.10, which I think we can make a little blue zone in there so it's a little more visible. No, let's just drag it out. Let's do it this way. Okay, good. So that's definitely a concern. The biggest concern is that we break the 67.89 level, because now that was our lower low that we put in there. Higher low, higher low. I love those, right? Then we put in a lower low. And as that lower low steps in, that's where the fear comes in, and that's where we have to start managing. And you'll see a black line down here. And if we get near that, we'll talk about it, but we're not going to today. It's a super fib. It's a major, major, major Fibonacci level, 67.65. It's a major fib level that we focus on, okay? But we're not there today, so we don't have to worry about that. If we look at VIX, which is fear, right? Fear factor. Fear's up, right? I've got my fear, my VIX broken into 3 color zones, right? You'll start to see some red. There you go, right? Yellow, green, and red. So all the way from 0 up to about 18 is yellow. From 18 to 29 is green. Above 29 is red. So if I am an options buyer, just a buyer of options, I buy calls, I buy puts, I like when the VIX is in the yellow. And the reason for it is my premiums are the lowest. If I am an options seller and buyer, then I really want them to be in the green, because I'll pay a little bit more for an option that I buy, but I can still get decent premium when I sell options. If you've ever done covered calls or credit spreads and you're trying to pick up premium and you've got a VIX sitting at 14, a VIX sitting at 14, it's very difficult to get any decent premium on that option when you're trying to sell it. So the green gives me a little bit more of a better area in there, right? So I do not have as much faith in VIX today as I did pre-COVID. I feel that it was a much more accurate indicator then than it is today. I feel we more deal with it today. I still use it, but I don't feel that it is accurate as it was at one point. Now, that's just one man's opinion, right? That doesn't mean I'm right. That doesn't mean you don't have other ways of looking at it. For the way that I use it, I find that there's more disparities, remember, VIX is a reverse indicator. If the market goes up, the VIX went down, because if the market went up, that means fear went down. And that's what the VIX does. VIX is a fear indicator, fear factor, right? Market goes up, fear goes down. I see many days where the market goes up and fear goes up, and it's not there. Now, there are times around a Fed announcement or something. I understand some of that, but just on a day when the S&P moved 80 points and to the upside, and fear is up that day and up a decent amount, I don't believe that it's accurate, right? But right now we're sitting about 17.5. We're low, but we're not that far away from green, right? And that's where fear starts to kick in a little bit. We don't get a lot of red, and we certainly don't get a lot of long-lasting red, but we do have red, okay? So there we were in the early part of 25. We ran up to about 60. We were higher than that. The all-time high takes us up right back in here, which is 85 and change, whatever it was there. That's the all-time high in there, right? Before I even started using zones. All right, and it took a long time for fear to actually get back in line to where we like to see it, all right? So last week I went through some techniques on drawing fibs. In other words, the things that I look for. Today I want to spend a few minutes just looking at a handful of candidates, drawing some Fibonacci on them, so we just can kind of reinforce some of what we did last week. So let me go and I put together a little bit of a watch list. Let's see. I have a lot of watch lists in here. All right. Just like that. Perfect. So very first one is ADP. Right? Automatic data processing. So I'm going to go over to a template with no moving averages on it. Ideally, you're working with a chart that has no technical indicators on the graph itself. No moving averages, no parabolic SAR, no Bollinger Bands, nothing. I don't care about the lower parts, middle and lower window, could care less about. But that upper window, I want no indicators on at all. All those indicators will do is force you to make bad decisions. Right? You can say, oh, well, I see this now, so do I have to pay attention to it? No, I don't want that to influence you whatsoever. So if you remember from last week, if not, go back into the hub and watch the last week's episode where we talked about the drawing of Fibonacci's and what we're looking for. And the main motto, main phraseology, if you do not know this, then write it down, is you are looking for the largest directional move closest to the right side of the chart. I'm going to step back to April, May of last year. So 8, 9 months, somewhere around there, 7, 8, 9 months. I'm going to look back in time, right? We're looking at later part of April. It looks like mid-April right in here. Okay. And what am I looking for? I'm going to get rid of my crosshair. So I just have an arrow. I'm going to grab a drawing tool, and this makes it abundantly easy. I am looking for a swing low. What is that? We had a low, a lower low, and a higher low. That's all that it is. It's low, lower low, higher low. And you'll see them over and over again. And same for highs. You've got a high, a higher high, and a lower high. Now, I did not give correlation between the first and the third candle. There's nothing in here that matters. Was this candle closed here? I mean, it had a high here. The next day was higher high. So the bulls were winning. And the day after, the bears said, oh, no, we closed lower. That's all it is. That's a swing high and a swing low. We need those to draw the fibs off of. So if we look, we've got a V bottom or a swing low in here. We moved up, kind of sideways, good, strong thrusting pattern, and then we fail. There's our swing top, right? So we can draw a Fibonacci off of that level. So again, every major charting package, or most, I shouldn't say every, most major charting packages have some form of fibs in there. Some are better than others. I use TradeStation as one of my platforms. It limits the amount of fib lines I can add in there that I can have as presets. This is Omega Charts. It's a program that we've developed, and there's not a number that I've run into yet. I probably have 30 lines saved in my Fibonacci for different trade setups that we use. All right. So what's happened now? We pulled back from this, right? And we had a pullback, a pullback, a pullback. We broke through. We'll go into rules one day, but this is the 882 right over here, the 0.882. We closed below there. So this fib basically does not have any value for us any longer. So we need a new place to draw from. So where's that new place? What are we looking at? Well, if we look, we've got a swing high there, and then we kind of go down a little sideways. I'm good with sideways. I like sideways. Big drop, big drop. We finally get a bounce inside of there. All right. So that would be my next place to draw my fib. From this swing low high to this swing low. I think it's this candle right here. Let's check. It's easier with a crosshair to see it. So we're looking at our lowest low of let's see, move in there. 247.21. The next day, 247.18. So it would be the next one, and then 247. Okay, so it's one day after. So it's the second bar. This right here, this is on 11/19 is where it is. And we're going to just drag the fib out to the right. Okay. So overall, we're sitting at a great little spot. We broke through the zero line, which is wonderful. We had a nice bounce back up. I think I mentioned it last week. If not, this 236, after you draw the fib, that will be your most important line of the entire fib for now, is going to be that 236 level. 236 has a meaning, and that meaning is hesitation. Stocks tend to move back up to the level, hesitate. Doesn't mean they won't break, but they hesitate there. So it's a really good place for a planned target, right? So if my resistance is at 262, okay, numbers are a little small. If it's at 262, maybe my target is 260, 258, somewhere in that area, whatever your number is going to be. But I know that we are going to tend to hesitate around this level. So you could see right in here, 2 days in a row, tapped it. We had a pullback in there. Well, yeah, but Rob, that wasn't really a bad pullback in there. And I'm not saying it had to be bad. The question you have to ask yourself is, if you bought something on a bounce in here, if you did take a bullish entry there, and you bought there and you had 262 as resistance, you saw this black candle on this day, you saw the next day we closed there, the day after we gapped down and started down, are you really hanging on to the trade still? You've already hit a major resistance. Now, maybe you've scaled out of it and you've gotten out of some of the trade, and I'm okay with that. Okay. But I'm going to tell you something that most Fibonacci traders will never talk about. All right. I want you to look at every single move from one line to the next as a one standard deviation move. Now, I'm not a math guy. I'm not a guru when it comes to school and all that stuff there. I did not do great in class. I was a C student. There were over 2,000 students in my freshman year. About 800 people graduated. A lot of people left the school, dropped out, left back, whatever it was. But I came in right about in the middle, right about 400, 4 and change. So I was a C student. I was really good at being average in school. I didn't do anything outstanding, at least academically. When it came to shops, wood shop, metal shop, auto shop, I shined in there, right? That was where I was really good at. I love that stuff. But each move, each line from one line to the next is a one standard deviation move. And we say the same thing for the 0 to the 236 and for the 764 to the 1. But realistically, what I'm actually referencing is from the 764 down to the 236. Each one of these lines is a one standard deviation move. That's important to understand. Two standard deviations take us to like 95% of all data points are met within a two standard deviation move. What does that represent? What does that mean for us? Well, if we look at APP, all right, standard stock for me on my list of one of the companies that I trade, right? So when you get a move, how long does the move last before you get some kind of reversal? All right, we got a breakout here. We broke out. We went one line. Forget about the 100-point level. We went one line, a little bit more, and we failed. We came back again. We went one line, a little bit more, and we failed. Well, guess what? With APP, if I took an entry here, if I went long, and I put my target 1 just below my first fib line, I put my target 2 just below my second fib line, I've now allowed for, if it does run, I can have the opportunity to run into that next target zone, right? We pulled back. We stopped right there. And then how far did we move down? We moved down 1, 2 lines, and we bounced. How far up did we go? 1, 2 lines, and we failed. How far down? 1, 2 lines, and we bounced. Yeah, but Rob, it failed from there, but it bounced. It bounced. That bounce was it was a gap. It gapped all the way up here. You get that gap up and you had a put, you playing bearish. Are you still staying in that trade? I can't. Right? I'm out. Well, but then it broke here. Yes. So then I'll enter the trade again. Keep in mind, I am more of a day trader today than I ever am a swing trader right now. Swing trading was my jam back, when I first got started in 1997. I did not want to day trade. Wasn't interested at all. Momentum trading. I didn't want to do anything with it. I was a swing trader. And for years, swing trading was it. I added day trading to my repertoire about maybe 8 or 10 years ago. And since COVID, day trading has taken over the swing trading for me. I don't do anywhere near as many swing trades. I do much more on day trades. So what happened here? We broke through. We went 1, 2, and a little bit. Oh, but Rob, so we went more than 2. I understand. There's 3 standard deviations and 4 and 5. But you get to 3 standard deviations, you're like 98, 99%. It's not norm. You're at 65% or so, I think, is 1 standard deviation. Don't quote me for it. Go to ChatGPT and ask it. But it's right about there, 98% for a 2 standard deviation, or 96. It's a lot, right? So we've got a 2-line move. So we go back to the stock here. And when you've got these fibs drawn, I now can identify where I'm looking at my targets to be, my next fib line, possibly the line after that. All right. So if we analyze any stock, it really doesn't matter which one we look at. If we put in Amazon, AMZN, it doesn't matter. If anyone wants to throw one in the chat, I'll pull that one up. Right. So look at what's happened. We drew from this swing low to this swing high. Right? We pulled back to the 236 and we hesitated. We failed through. We came back 1 line, almost 2, but 1 line. We broke 1, 2, 3, 4.5. Wow, that was pretty cool. We gapped up and we went 1, 2 lines. We failed 2 lines. We went up 2 lines. Came back to here 1 line. We went 1, 2, right? And then 3. Pulled back in here. We bounced. So we went 1.5. Came down to here, 1, 2, 3, and we pulled back. right? So my whole system is predicated on taking small exits along the way. I've got a standard 4 exit system. So if you have at least 4 contracts as a minimum, of course you need at least 4. 10 is more the standard of the way that I do it, don't look at it a number of contracts, look at it as a percentage. I will exit 40% of my trade at my first target. I will exit 30% of my trade at my second target. I'll exit 20% of my trade at the third target, and the last 10% is a runner. That was where that 5 moving average comes in, and I just let it go. There are times that last runner on a swing trade will be worth more money than the 9 contracts before that, or the 90% before that came along. Okay. So let's look at one more stock, and I'm just going in alphabetical order here. So we're going to go back. All right. So we've got this is where, and I purposely picked ones that were not going to be easy. Actually, all the easy ones I already have them identified as ones for tonight for a class that I'm teaching this evening. But if you see here, we're in this kind of sideways move, right? We get a little bit of a drip up, a little bit of a drip up, and then we get this big move and then this pullback in there. So we've got a very, I don't want to say ugly because it's not ugly, but from a standpoint of Fibonacci, I don't have a lot of great locations to draw off of in this area here, okay? When we pulled back to this bottom, we moved up, kind of a sideways move, quick pullback and sideways move there, nice move up, and then a strong pullback there. So let's draw the fibs off of that pattern. Let's come off of that swing low right in here up to that highest high. All right, we're going to pull this out to the right. And what happened? We made our move up. We came back to the 236 and we bounced. We went back up, didn't quite make it to the 0 line. We hesitated here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, something. Over here, we got a good strong move. We broke out of the 0 line. Good strength from a bullish standpoint. When we broke it to the downside, we went 1 line, we went 2 lines, we went 3 lines, right? Right now on the upside, 1, 2. It's pretty standard. Don't count on the 3rd line. The 3rd line should be your runner at best. At most, you want to look at having maybe 1 or 2 contracts left, 10, 20, 30% of your trade left after the first 2 targets are hit. I have found in the analysis I've done, if you exit 70% of your trade, by the time you make a 2 standard deviation move, a 2-line move, you've got the best odds of being right in the trade and still enough left over that if the stock does take off, you've got a great profit potential on the contracts you have left. If it pulls back a little and goes the other way, yes, you give some back, but your stop is going to keep you in a place, barring a big gap. Your stop is going to keep you in a place that you will have not given all of it back down to where you bought the option. Right? If you moved up to that first line and your target was hit, your stop gets moved up now. You move to the second line, your stop gets moved up. If it comes back and hits your stop, so what? It's going to happen. And I'm okay with that. I don't ever plan on getting in the trade at the lowest low, and I don't ever plan on getting out of the trade at the highest high. Just no, you won't do it. Just forget that completely. It's not going to happen. Okay? Best way to do this is to take an approach of 1 step at a time, 2 steps forward, 1 step back. 2 steps forward, look at the move that we drew the fib off of. 1 step back. 2 steps forward. Oh, that was bigger than 1 step back, Rob. Yes, but you remember this line, just like any support line or zone or anything else that you draw, does not guarantee it never breaks through there. Oh, that's it. We drew a line. We're good. Golden, this is awesome now. No, it doesn't work that way. It doesn't work that way. That line will be violated over and over and over again. The key is, how do you react around those levels? How do you manage your position around that? That is the difference between what makes a good trader and a great trader. That's the difference of someone that survives in this industry versus someone that can't make it or doesn't last at all in here. All right? And there you have it. All right, everybody. With that, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just 1 trade away. I will see all of you next week at our next show. Take care, everybody. Have a great day. Bye for now.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.